The Ombud has found in favour of the investor with regards to the Sharemax debacle, obliging the advisor to pay 800,000 rand after having been found guilty of providing inappropriate advice. To discuss this and to get more investment insight, I'm joined in studio by Mike Estment, who's CEO of NFB. Mike, thanks so much for joining us today.
Good afternoon.
Well, let's get straight into the story because for a while now we've been hearing of the story where investors got caught up in property syndication, investing in property developments via Sharemax, but then to find out that down the line those payment obligations weren't being met and weren't being able to be fulfilled. For those not familiar to the story, what actually happened here?
Well, I think that no one really yet is familiar. There's been an interim board of directors put in place to try and manage what is a real funding mess out of that mess. That's not going to be easy. And typically the loser in this type of event is the person that goes into this investment. The question is, do they go in with their eyes open or their eyes closed? I think that the finding of the Ombud, if you look at the particular case, is highly appropriate because the advice given was to a person, in this instance a lady. It was 30% of her worth. It went into a proposition which was definitely medium to long term in nature. She had indicated that she might need liquidity a year or so down the road. The fees earned were in excess of, I think they were 8 or 10% of the total investment made, which must immediately say what was the agenda on the advisory side. But having said that, I think investors, whilst we've actually participated in your show, I've been saying caveat emptor, which is beware the buyer, for a long time now. Interest rates have plummeted. They look to remain low for a whole lot longer, and investors are probably inclined to sort of say, well, how the hell can I get back to the position I was in 2 or 3 years ago? The danger there is that if the big guns are paying 5 or 6, if you're earning 12 or 14, there's got to be some reason for concern. So whilst the advisor is obliged by law to look after the interests of the client as his departing point, there is no question a responsibility on the investor as well, because not all advisors will be able to pay up. So if the Ombud says you pay 800, the question then is, does the person have the wherewithal?
Absolutely. So at least this first ruling setting a red flag up and creating awareness amongst investors as well. What kind of precedent does this now set, and how much more to unravel in your books?
Well, it's a multi-billion rand saga, and I think you have the central bank involved. You have a board of directors, almost a business in distress. But the distress is probably, and I don't know the inside track, but the distress is also there for the fellows that have to try and unravel it. Is, if you've taken from Peter to pay Paul, and I've invested in project 1 and my money suddenly ends up in project 3 or 10, to try and undo that is a nightmare. So there's lots more to come. I think it's going to be a very, very messy picture. There's going to be a lot of objection by parties to outcomes. But the reality is that you've probably had a degree of naivety on the investor side, and no question a massive amount of greed in the providing of the product and the advice, in our opinion.
All of this happening in a context of extreme volatility on the market scene, uncertainty as well, where investors are already risk averse and searching for value propositions. How strong is the value proposition that's being put on the table by foreign investments in your books right now?
Yeah, right. That's a $64,000 question. Is that do you go out of the local unit? And the local unit is showing, like many currencies, massive volatility. In fact, not unprecedented, but not sort of the recent precedent certainly is extraordinary. We've just seen major swings. The South African currency is also probably further compromised in the short term by the sophistication of our market makers and the kind of transparency and the depth of our markets. So, for instance, if someone were to want to sell out of another emerging currency and their markets were inefficient, maybe what they do is they take an over position on the sell side on the rand, or on the flip side over invest, and then sort it out and balance it out later against the Turkish unit or some other emerging unit.
Yeah, taking a look at things, I mean, right now we've got individuals' allowance for foreign investment effectively sitting at 5 million rand per annum. But having said that, investors can, as of this week, possibly do more with that allocation, given the fact that we've got inward listings now being listed on the local bourse. So that exposure giving you access to a lot more moving forward.
Yeah, well, I think that the Reserve Bank have done a very fine job of, in a controlled way, doing away for all but the wealthiest South Africans of exchange controls. So from a commercial point of view, corporate South Africa is still constrained, but massively less than they were in the sort of pre-94 period. And at an individual level, you know, there are not too many individuals I know of that can, for themselves and any other tax-registered adult in their family, take 5 million rand a year overseas and worry that they have more than they would like to do. There are also transactions happening where you can, on an application, take more than the 5 million rands for very high worth individuals. And that's also logical, because I think the central bank and the fiscus are saying, well, if we don't allow for greater figures than the 5 million to go, then you might find ultra wealthy South Africans leaving the country to achieve that end. Rather keep them there, because then you keep their portfolio within the South African fiscal reach, and you earn tax revenue on it.
Okay, so we've got that scenario unfolding, and as you say, the currency to consider on the other hand. There's also a lot of caution in this period, given the uncertainty that's playing itself out in the Eurozone still, and that despite the Friday summit as well over in the EU territory. What do you make in terms of the kind of caution that you should be, as an investor, executing right now?
Well, that's an excellent question. I think that the point that I would make is that the investor with significant new money to deploy would be advised to trade very cautiously. The markets are thin at this time of the year, so what I mean is that half of the players are away either in Cannes or Nice, if they're European, or in the Bahamas, or wherever the Americans go to. I think there might be more localized holidays than the global ones, given the poor bonuses I hope they get. They don't deserve them. But so I think that there's a lot of nervousness out there. There's a probability that the markets will go through some significant swings, given the fact that half the market players are going to be away, and those that are behind will cause mischief, as they typically do in thin markets. So I'd advise caution. I think that the point is that you're earning very little in hard currencies on fixed interest. So to go into markets probably makes some sense, but to do so in one big bang, one big shot, would be ill-advised.
Of course, exercise caution and then take cognizance effectively of the opportunities that are out there, because if you're looking at the low rates that are prevailing in the current market, for example, you've got investors questioning the merit of holding cash and earning interest of that in the bank.
Yeah. In the pensions industry, which is a very, very important savings industry, interest is not taxed. In the retail space, yours and my space, and that of high worth individuals, the tax is a very real issue. For individuals and trusts, the tax rate can be as high as 40%. So if you're earning 5% in the money market, which is a decent rate right now, you're earning 3.5 after tax. That's not a great big hurdle to maybe achieve by investing into a property fund with a decent return, where at least then you also over time will get capital gains, or into shares where the dividend yield might well be 2, 3 or even 4% if you really look around for some value stocks. But the money market, if you stay in that space, check with your bank, check against money rates, money fund rates that are available from advisory businesses and in the media, and compare apples so that you make sure that you're getting good prices. But the same old caveat that I warn about and have done for years: do not take 9 or 10 if the going rate's 5 or 6. It's just there's too much risk out there right now.